Everybody, this is Justin Bogart from Bright Path Notes, and welcome to the Real Estate Note Investing Be the Bank Meetup for 2021. Hope everyone's having a great new year so far. It's only been a couple of days, but I'm excited for this new platform that we're on right now. It's called StreamYard, and we're streaming this live to our YouTube channel and also our Facebook group. That's the Real Estate Note Investing Be the Bank Facebook group. It's also streaming there live right now as well. So I'm kind of new to this as well, so I'm learning just like you guys are if you aren't used to a live broadcast like this. So I know on YouTube you can leave your comments in the comment section and they'll pop up here in front of me for me to read them and answer some questions for you. And if you're on Facebook, you need to give StreamYard permission to be able to upload your comments with your name and your profile picture. So it's a little bit confusing, but that's kind of how it is on that platform. So hope everyone's doing well, and please chime in and say hi if you want, and I'll be reading those off as we do our little presentation here. So without further ado, someone on Facebook says hi. Hi. I don't know who you are. It just says anonymous on here. So so I've been doing this meetup for a while. Probably about going on 3-4 years now, and every meetup we get more and more of an audience, and we get an outreach. So we're really excited in 2021 that we've got, I want to say we got over 600-700 members now in our reach for our real estate note meetup group, which is awesome. And so one thing I like to disclaim here is I'm not an attorney, I'm not a tax consultant, and I'm definitely not a financial advisor that I know of. But this meetup definitely wouldn't be possible without some sponsorship. So we have our company, Bright Path Notes, who we have note deals. If you check out the website, we got our note deals on this page. Assets we sell, we have full loans, we have partials as well. So that's what we provide to the group. Cyria is our local real estate investor association club. Vicki Perry runs the organization. There's her number and her email address up there, and pretty much anything that has to do with real estate as far as education, they're a great organization to get a hold of and just see what they have to offer. It's a lot of content, I'm telling you, a lot of content. That's actually where I got started. And so our other sponsorship is called Launch Fishers. It's in Fishers, Indiana, which is a little place just north and east of Indianapolis, if you're familiar with the Indianapolis area. And so they are basically a shared workspace. So if you're looking for a place to, if you're local here, you're looking for a place to kind of, you don't want to be at home working, or if COVID restrictions allow, you're allowed to get out and you can meet people at this place. They got great conference rooms, private phone booths. They got high-speed internet connection. They even got coffee bar inside. It's pretty great. So that's where I am a member there, and it's been working out pretty well for myself. Our last sponsor for our meetup is Dickie Baldwin at BAG, better known as Baldwin Advisory Group. And Dickie is the one bag for all of your real estate services. There's Dickie's phone number and his email address up there. Reach out to him. He's really good for due diligence stuff. We use him really often for title work, and we also use him for property inspections or BPOs if we need them. That's the main thing that we use him for, but he's got a lot of other ancillary services as well. So go check him out. So those of you that are part of Cyria, this is actually a note meetup group. It's a subgroup called Notes, and Cyria has a couple of things that you can follow them on. They want me to point this out. They got Indiana Cyria for the Facebook page. They got a LinkedIn page as well. You can read off that tag there, and they got an Instagram page. They also have a YouTube channel that's got a ton of videos on there. It's all free. We got a lot of people that are in that are landlording, a lot of people wholesaling, fix and flipping. We got people like me that are doing notes. They got commercial real estate stuff on there, land investing, almost any and everything you can see out there is available on their site. So you can also, if you're part of Cyria, you're going to log in and get your PHP credits. So you can either take your smartphone, pull out the camera, kind of hover over that QR code, and it should pull up a link for you to log into. I think you just put your name and your email, and you'll get PHP credits. Or if you can't do that, then you type in this URL that I have pulled up here on the screen. All right. So, bear with me as I am working through how to do all this stuff. Someone says aye. All right. Fantastic. If you didn't know already, I have a podcast. I am a co-host on this podcast. It's called The Two Wealth Show. My friend Super E is the other co-host. She is a short-term rental person. And we talk about anything and everything in real estate. We interview a lot of people in real estate and just learn from what they do and what they know and how it can benefit you and grow your wealth is the whole idea behind it. So we're on all the podcast directories that you can think of. There's 30 or 40 of them, it seems like. We also record the video stream of the podcast that we do on our Bright Path Notes YouTube channel. So if you are in our YouTube channel now, you can probably steer off when this recording is done. And you can find all the videos we've done. We're on a third season, our episode 1 of season 3 just released today, so you can check that out. We would much appreciate that to subscribe to that. So today's agenda is going to be about the note basics, just things that we go over. If you're not used to the note world here, we can kind of go over what the basics are from where we start from. And then also we do a mortgage industry update to kind of find out what is going on in the mortgage industry. And then I got an asset that I want to show you guys as a review of a pretty cool little case study that happened. So we'll walk through that at the end. So if you got any questions, do not hesitate to fill out the comment box wherever you are watching this from, Facebook or on YouTube. And I'll be happy to answer them as best I can. I'm kind of running 2 machines here, so if you see my eyes going in different directions, it's because I'm looking at different monitors to find out what's going on. I'm a one-man show today. They call it Stump the Band, right? If anyone wants to chime in on that comment, you're more welcome to. All right, so this is the note basics. So I try my best to explain what the heck we do in the note business, and the best way I can show that is through illustration. And this illustration here is, Mr. Seller and Mrs. Buyer. They obviously have a house that they're mutually going to come into an agreement with, and whatever that value is what they agree to sell and buy for. So there is a deed on the house, and the seller of the house is going to convey that deed over to the new buyer. So now they are the owner of the house. The buyer is typically going to need some help financing the house. They're going to go to a bank. They're going to call up Chase, Bank of America, whoever, and they're going to get a loan for the remaining balance that they owe on the house because they're going to put down some sort of down payment, right? So then the buyer gets what's called a mortgage note or a note and mortgage. It's called mixed that way. And then, so this is what the key ingredient is here. The bank owns the note. They don't actually own the house. You, the buyer, if you're in that situation, you own the house. And the bank note is secured by that collateral, that real estate there. And so that's how paper is created, right? We've all kind of been through it. So the bank owns the note. This is the key part of it. And the buyer holds the deed. They hold that paper to the house. So those are the main distinctions here. Now let's get into the other part of the business where we are investing in it, right? So we have the homeowner, and there is the security for the bank note, and they're on the deed, right? There's the bank, and they own the paper. So we have an investor over here. Now this investor can invest in that mortgage note that was created. The investor can be an LLC, it can be an LLP, it can be a trust, it can be a self-directed retirement account, it can be a solo 401k. Pretty much anything that you can think of that has a lump sum of cash can acquire this paper. And this is what happens. The paper is traded for money, paper for paper. So now the homeowner is going to make their monthly payments to the investor, right? They're not going to pay the bank anymore. They're going to pay the investor. So their monthly payment, instead of going to the bank, it's now going to the investor, whether that was an LLC, a retirement account, so on and so forth. So any questions about that, feel free to chime in, and I will be glad to answer them. Good evening, Patrick. 2021. Can you believe we made it 2021? Not a lot of things have changed really since 2020 because it's been so new, but everyone's been waiting to get to 2021. So here is our mortgage industry update. I thought this was interesting. I was looking at bank CDs, and apparently the CD national average as of this week is a 1-year CD is 0.21%. 0.26 for 2 years, 0.29 for 3 years, 0.32 for 4 years, and a whopping 0.36% at 5 years. Can you imagine if you had your money in a CD for 5 years making 0.36%? I wouldn't even want to do the math on that because I think that would just be so deflating to see what that is, especially when inflation could be 2.5 to 3% or even more, right? So I just thought that was really interesting with the times we have now, looking at CDs. So this is a snapshot at, I believe it's bankrate.com. Some of you may be familiar with that site. It's a pretty popular site just to get mortgage information and loan information on. So I was curious to see what the heck is a 30-year fixed mortgage rate as of right now. So you can see at the top of the screen there, if it's a new purchased home, if you're spending about $400,000 and you put 20% down, so you put about $80,000 down and you got a 740 plus credit score, a 30-year fixed mortgage, your rate is going to be 2.375. It looks like for these happen to be 4 loans. It looks like they're probably online banks. So the APR, if you're not familiar, the APR is just basically adding the points into the rate, and that's coming up with your true APR annualized. So that's what that is. That's why you see the 2.482 on the better.com versus the 2.375. So yeah, your monthly payment is going to be $1,225 on a $320,000 mortgage. That just doesn't seem right. That seems too good to be true. Seems like a lot of house, a lot of for a low payment, right? Relative to what you think a $300,000 mortgage would cost you. So, anyways, if you're not familiar, the CFA of Bankrate, he is Greg McBride, and he had some quotes that he put out recently, and I wanted to read those off. So he basically expects rates to end at 2021 at probably about 3.1%. But he says there could be some dramatic swings throughout the year. So this is his quote here. It will be an especially volatile year for mortgage rates, with fixed rates falling to even lower lows early in 2021 on economic concerns, but rebounding in the back half of the year as widespread vaccinations lead to a surprisingly strong surge of economic activity and the inflation worries that come with it, McBride says. So his rate forecast is in line with the general consensus among house economists, and the National Association of Realtors expect mortgage rates to be an average of 3.1% throughout 2021, which is up 3% from 2020. And the Mortgage Bankers Association, or the MBA, says rates will average about 3.3%. So they're all kind of in line with that, just to see how the mortgage rate industry goes. So if you're thinking about locking up a refi or purchasing a new home, this might be the time to do so, right? All right. Let's get into some more good stuff here. So I saw this picture on the internet when I was perusing some graphics for today. It says effects on interest rate on. So if you look at, I'm looking at the left side of my screen, which is the dark blue stuff. It has some numbers. So this is your monthly mortgage payment for a $500,000 home. Okay. So the first line you see there is a $1,690 monthly payment at a 3% mortgage rate. And then below that would be 3.5%, 4, 4.5, 5, 5.5, 6. So if you had a 6% rate on a $500,000 house, it'd be a $2,500 payment. Okay, now you flip to the other side and you look at your buying power. So the maximum home price you can get for a $2,500 mortgage payment based on an interest rate is at 3%, it would be almost a $750,000 house for a $2,500 payment. At 3.5%, you see 4, 4.5, 5, 5.5, 6% was about a $500,000 house. And this, of course, is based on a 30-year fixed mortgage with a 20% down payment. So these are the cream of the crop borrowers here. So can you imagine $750,000 house for a $2,500 payment? It just seems off. So that's what is going on right now in our world as the banking industry for conventional mortgage rates. It's kind of mind-blowing, right? So like I said, if you guys are filling out comments and stuff, feel free to shoot over some comments in the comment box, whatever platform you're on. And if you're watching the replay of this, unfortunately you can't leave a comment live. maybe you can leave it on the replay and we can get to it. All right, so Black Knight Financial Data is a company that has a lot of information about what's going on in the mortgage industry. So I typically pull a lot of information from there as it pertains to loans that we would invest in. So they track Fannie Mae, Freddie Mac, Ginnie Mae. They track VA loans, FHA loans, conventional big bank loans, and stuff like that. And they give us kind of a heartbeat as to what's going on. So a lot of us have been monitoring this pretty closely just so we can see what defaults rates are and stuff. So kind of don't look at all this noise in front of you. We're just going to focus on a few things just to make it simplified. So if you look at the total U.S. delinquency rate, loans 30 or more days past due but not in foreclosure, it's already down to 6.33%, which is about another 0.1% jump down in a positive direction since December. I'm sorry, this is November data, so it's since October. They don't have December data out yet. They'll have that later in February, early March. So despite all the seasonal headwinds, mortgage delinquencies improved for the 6th consecutive month in November. Like I said, they're fallen 6.33%, as you can see, versus the 6.44 the month before. So it's always been trending in a positive direction. It's been trending for 6 solid months, which is a really, really good sign. Okay, the national delinquency rate is now down 1.5% from its peak in May, which was about 7.8% as a default rate, right? So while early stage delinquencies, borrowers 1 or 2 payments past due have fallen back below pre-pandemic levels, seriously past due, which is 90 plus days delinquent on a mortgage, remain about 1.8 million above pre-pandemic levels. So I believe in total we're looking at about 2.2 million of what we'll call serious delinquent notes. So it would appear that the loans that are 30 to 60 days behind, they're getting caught back up and they're not as much of an issue. But once they get to the 90-day number, there's not a lot of counties that are allowing foreclosures right now. So this number obviously gets ballooned if the borrower is not getting caught back up. So it's 2.2 million mortgages that are in serious default right now. And so once foreclosures start to be allowed in these certain counties and states, as this happens, you can see a big funnel of loans coming to foreclosures, and we'll probably see a good amount of non-performing loans come through. Now, I don't think it's going to be a tsunami like it was in 2011, 12, 13, and 14, just because there was a lot more loans going through the pipeline at that time. So it'll be somewhat like it, but not to the extreme that it was, in my opinion. And I don't see them available anytime soon. It may be late summer, probably next fall or winter time when we actually can see them, when people like ourselves can invest in them. The 1 to 10 loan buyer is what I call ourselves. Wish we could buy 1,000 at a time, but that's just not in the cards today, is it? So, yeah, I'm trying to look at some data points here off screen. So 4,400 foreclosure starts were actually in November. So there's 176,000 loans in active foreclosure. They're at their lowest levels, obviously, since Black Knight reported the data since 2000. And that makes sense because counties aren't foreclosing right now, right? So prepayments fell 11% from October's 16-year high. But with interest rates as record lows as they are, the refinance incentive is at an all-time high, as we know, right? The prepay activity is likely to remain elevated in the coming months. So, sorry, I know I keep looking away from the camera, but I'm checking to see the comments. All right, so I don't know if you realize this, but some states are hit harder than others. So with the November data that came in, we know that Mississippi was the unfortunate recipient of the hardest hit award this time. So these are non-current loans, and non-current means a combined foreclosure and delinquencies as a percentage of active loans in that state. So they're saying in the state of Mississippi, there's over 11% of non-current loans, mortgages in that in that state are non-current, which happens to be the highest number that we see. Louisiana comes in second. Hawaii, New York, Oklahoma. There's probably a lot of states that hit that 8%. So let's flip it on the opposite end of that, and we'll say state's doing well. So we got Montana, that's a very low percentage there, 4.35. Oregon at 4.33. Colorado 4.19. You guys can read them in Idaho, 3.45. Woohoo, Idaho. That's pretty low rate for a default rate. You also see they had peak rates and stuff, and you get into this data a little bit more. Like I said, you can go to Black Knight Financial Data, and you can really dive into this stuff, and you can see those numbers for yourself. They'll come out with a full report probably in a few days, but right now they kind of gave us a snapshot of what November looked like. Okay. I've got things chiming in the background over here. So the asset in review for today is going to be an asset that we purchased for one of our accounts. And it is a performing first lien mortgage. It's actually a contract for deed, what we'll call an agreement for deed in Inkster, Michigan. I kind of wish I would have got on the map and found out exactly where it's at on the glove, or the mitt, I should say, in Michigan. I don't know where it lands at, but it's up there. So come to find out, there's a mother and daughter that are borrowers. So both of their names were on the agreement for deed, the security instrument. We purchased this note actually a year ago. I want to say it was January 20th, so about a week from now is when we purchased it last year. It rented for about $980 for this little house. It's worth about 40, maybe 45,000. We'll be conservative and say 40. It's a 3-bedroom, 1 bath, about 950 square feet in Inkster, Michigan. So not a bad looking house, good piece of collateral. It's very well maintained. The mother and daughter borrowers, I don't know if that's really good or bad, but it just end up the mother and daughter there. So I'll get to the end story, and we'll find out more about this situation. So this was a recorded, we call them CFD, or AKA land contract. If you don't know what a land contract is, basically it's like a note and mortgage, except we treat it as if it's a car loan. So if you ever got a car loan from a dealership holds that title. They don't give you the title. They let you make installment payments on that car until it's paid off in full, and then they give you the title to the car, right? So this is the same thing when we have land contract or contract for deeds, where the bank actually is on title with the house. So me as the lender, I actually am on the deed to the house, and I actually have written a contract with the borrower where they owe debt. So that's what I bought. So I bought this land contract, and so I'm the deeded owner, and I'm the land contract owner as well. And so if anything were to pay off or to refinance, they would have to come through us first to get the mortgage paid off before we can release the loan. So that's what that is. So unpaid balance is around $29,250. The interest rate was 9.9%, which isn't uncommon for these really low balanced houses, or these really low valued houses. And the P&I, the monthly principal and interest payment, not taxes and insurance, just principal and interest, was about $287. And when we were buying this loan last year, it had about 224 payments left. So it was a 30-year mortgage, so it was a very long mortgage. That's why the payment is very low, but the interest rate's really high, so we liked it. So we liked a lot of things about it. The collateral looked really good. We felt like we got a good discount on the note. The payments coming in, we saw they were making really good payments and consistent payments, so we liked it a lot. So we went ahead and pulled the trigger on it, as they say. So we purchased this bad boy for about $25,000, and felt like we got a pretty good deal on that. So if any questions, go ahead and chime in. So we get this loan, and then it turns delinquent. It didn't turn delinquent right away, but we're able to get about 8 payments out of the borrower. So if you multiply 287 by 8, you get $2,288. That's how many payments we collected. So just looking at this like on a time scale, if you will, they made 8 payments. I know that's more than 8 payments on those 250s over there. Sorry about the 250s. I just realized that I used an old graphic and I didn't update the numbers right, but you get the idea. So it's the cash flow. We got 8 payments of cash flow when we bought it. Thought things were great, and about 4 months ago, this loan started to default. So they basically just didn't pay for 4 months, and I'm fast forwarding up until now. So what was happening was we found out that the borrower had called us over the summer, and they said, mother passed away, and I'm not living in the house, but I'm trying to get the house for sale, to sell the house. And so we heard some information from her for a few weeks, and then we didn't hear anything. So she kept making payments, and she made about 2 or 3 more payments. And then all of a sudden, she just had no contact with us, and she went completely dark on us, as they say, or ghosted us, if you will. So, come to find out, she reached out at some point. I want to say it was in December, so last month, and just says, "Hey, the house is sold, or it's under contract to be sold, and here's our closing date, blah blah blah, in January." And so we're like, okay, because we had already started foreclosure. We had already talked to a couple of attorneys, and they had told us that, oh, that county is not doing foreclosures yet, and you could pay such and such amount of money every week to wait in line to see if they're going to allow foreclosures or not, but they don't anticipate opening the floodgates for foreclosures until more like March or April timeframe. I was like, okay, this might not be a good situation, but ended up being pretty good. So we had acted like we were going to start foreclosure, and then all of a sudden we got this phone call in December, and it made our mind at ease. So as the borrower's not paying, they're collecting interest on all the payments that they're not making. So they're accruing interest. So we call those arrearages. So they're building up a pile of money that's just interest every month, every day, compounded. That's just building in an account. And then plus any advances that we had made on the loan to go through the foreclosure part of it. So those are called arrearages and advances. So we total that up, and the borrower is going to owe pretty much over $30,000, maybe $30,500 or close to that. So we'll just call it over $30,000. I don't have the exact payoff for it. So I should have changed that slide to non-performing, right? Because it's not performing now. So we paid $25,000 for this, $25,215. We collected about $2,200 on this note, and the payoff's around $30,000. So we basically profited about $7,100 on this loan, and keep in mind it's basically a year, almost 12 months to the day, and it's a 30% ROI on our money, which we weren't expecting a 30%, but obviously that is a pretty big, large reward considering how sideways it could have gotten on us. And so that's just one of the more profitable loans that we had in 2020, even through all this pandemic. So I was thinking this loan would have gone into delinquency because of COVID, but on all actuality, I don't even recall one of our borrowers being late during the whole COVID process. And as a matter of fact, most of our investors, I don't recall anybody contacting me about any of their borrowers not making payments because of COVID-related stuff. So it seems like we've all had some pretty good luck getting our way through this. And so this was a pretty good deal, pretty solid return for us. We weren't expecting to make that much on it, but I'm glad that we did. And that is the case study for today. And like I said, yeah, that was 12 months, almost to the day of when this loan made its way through. So I know we didn't cover in great detail a lot of things, but I kind of want to leave this open for questions about what you just saw in this case study. So I'm going to kind of check out some of the comments that we have going on. Feel free. You don't have to ask a question specifically about this loan or this case study or about what we talked about today. It can be really anything related to the note business. If you just have a general question, that's perfectly fine too. We definitely allow plenty of time, like we are now, to open the floor up to talk about whatever it is that we need to talk about. I was expecting to have a lot more difficulties with this new way that I'm doing this meetup, so I was expecting myself to fumble my way through this quite a bit. So I wasn't anticipating getting done as quickly as I did with this case study. So feel free to chime in. If you're not able to chime in, I understand. Maybe it's just new to all of us. Yeah. So we have, I'll go through some of the meetup stuff while you guys are still filling out some questions for me. So our next meetup is February 10th from 6 to 8 p.m. We do encourage you guys to follow us on social media. We have a Facebook page, we have a Twitter account, we have an Instagram account as well. If you want to reach out to me directly, by all means do so. It's justin@brightpathnotes.com. You can ask me any question. We also do have a Facebook group, and some of you are on our Facebook group right now and you're watching this live feed. And if you're not, just go over to Facebook, find the groups, Be the Bank, Real Estate Note Investing, and you'll see this Be the Bank picture in the background is kind of our cover for it. And so go ahead and sign up for our meetup as well. And we'd love to have you part of it. We have people that chime in all the time and ask questions, and we have 2 or 3 other moderators on our Facebook group that can answer questions about what you guys have. So if you're looking for note deals, absolutely, you can contact me directly for note deals. We definitely have loans for sale on our website, like we showed before. And if you're a broker or if you're looking to actually close loans, we can help you with that as well. We got a lot of experience closing loans. We work with other people that can help us with documentation, a lot of attorneys. And so we can definitely close loans for you if you're unsure what to do. So by all means, leverage off of our experience and stuff, and let us do some of the heavy lifting with you and for you as well. So be happy to help you out with that stuff. Okay, so your name and profile won't come up because of StreamYard needs to have you give permission for them to take that information and post it. So this is going to be our anonymous Facebook user here. So it says, what is the plan if your CFD continued performing, sell after a year, hold? How would the ROI compare to the 30% you got with the payoff? So that's a good question. So if it continued to perform, we're probably going to ride that wave. It probably depends on what account that our money is in that we deployed for this loan. So if it's in one of our company accounts, it's probably going to have to be recycled at a pretty quickly relative to a couple of years, maybe sooner. So we would want to use a velocity model and resell that loan because that's what the business model is for that money. If it's in our retirement account, my God, we're just going to hold it and let it ride. We know it's going to pay off at some point. Now, there's no guarantee, but we know it's going to pay off at some point, and so we let that ride. So we like to build our account and our retirement accounts with just a lot of loans, just let them build. And also we can sell partials if we need to as well to recoup some of our capital back. So I would say for this particular one, if it held true, I would say that we'd probably sell it. I would probably start offering it for sale after a year, which is fine. And the worst case scenario is I'd keep getting good cash flow from a really good borrower, right? And then the other worst case scenario, if I sell it, I can still make a little bit of money because I can probably sell it a little bit more than what I bought it for because we got this for a good discount. And so we can make a little bit of a spread that way. So you can kind of see how the math worked. So the ROI would probably be little bit different depending on how long you hold it or what you sold it for. The best case scenario happened to where I got a full payoff on this loan. And so that way I could get the most money for this loan, right? So that was the best scenario. So good question. John asked, so is the house actually sold? When do you expect payoff? Sorry, it took me a few minutes to learn how to chat. I know the feeling, John. I know the feeling, okay? So I'm learning this stuff just like you are too. So the house, I believe, is closing today or tomorrow, and that's when I'll be getting my payoff. So just to kind of fast forward so you understand how it works on the lending side. So once someone is committed to a closing, borrower is, we get notified because we're on title. So they say, hey, Justin Bogard, we notice you own this asset. This person's wanting to pay this off. We see there's a land contract recorded. And so then I immediately forward this stuff to my servicer and get my servicer involved. So my servicer is the one communicating with the title company. They're telling them what the payoff is because they have to calculate all those arrearages and the advances that I made and the servicing fees or whatever else I advanced, if I had to pay any taxes or insurance stuff on there. And it's all going to be one big lump sum of money that they owe. And they give that to the title company and say, here's a payoff statement. It's good to January 31, 2021. And so when they go to closing this loan, hopefully, and we got the agreement that says, the purchase sale agreement is for, I don't know, let's just say $40,000 and they owe $30,000 to the banks. And then obviously they would make the difference of their title closing fees minus the $10,000. So that's kind of how it happens, and I should be getting paid off any day now. I'm not sure what day exactly it closes, but that's what it is right now. It's a good question. Fun, exciting. So this format wasn't too overbearing. But yeah, if you guys have any other questions about real estate in general or real estate notes in general, not just real estate, I'd rather just stick to real estate notes if we could. That'd be great. So just reach out right now through the comments box, and I'll pull stuff up there. I'm getting a little bit better at this, guys, so go ahead and start feeding me some stuff. Even if you want to say hi, it's still okay, too. Yes, don't forget, there's our webpage with where our note deals are at. We got a couple partials for sale. These are great for first-time note investors. That's what these deals are for. We don't really like to sell deals that are a little bit risky. We'd rather keep them in our portfolio in case something happens to them. But for all intents and purposes, we love to sell to first-time note guys and gals. We like to help you from the process from A to Z. Like I said, we'll even walk you through closing. Okay, John's follow-up question. So the house is selling for more than what you are owed. That's correct. So because the borrower, I think they made their last payment in September. So that means they missed October, they missed November, and they missed December, and they're missing their January payment as well. So they're basically missing 4 payments. So since September, they're accruing interest on a 30-day cycle, maybe compounded daily probably. And so that interest is building. So because they're not making a principal payment, that interest account is building. And I think it was over $1,000 in just a short amount of time that they owed just in interest on top of the fees that I had sent out, attorney demand letters to them. And we send out door knockers to the house to find out what's going on because they went completely dark. Like I had this person's phone number, I had their email address, and we had just like no contact from them for at least 90 days. And so we thought the worst case scenario, something happened or they walked out or they were going to torch the house. So we immediately sent somebody out to the house to make sure, like, is it still there? Is it still there? Right. And luckily it was. So hopefully that answers your question, John. Hey, Patrick, how do you determine what you keep in an LLC and what you put in a self-directed IRA? So that's a good question. And there's really no wrong answer. It really just depends on the note in front of me. So if I have a note that maybe is a little bit more risky and not a plain Jane set it and forget it type of loan, I'll probably put it in our company account just because I can be more fluid with it and I don't have to worry about my IRA and going through a custodian when problems happen. It's not an issue. It just becomes another 1 or 2 people where I don't want to get involved. So my retirement account is just going to have a lot of loans that have they're just bread and butter loans. I mean, I don't know how else to put it. They're just nice loans. They're all performing. I don't put any non-performing in my retirement account. I put all performing, and I just let them build. And we have something called the 10-year model, too. If you go to our website at brightpathnotes.com, we have a page called 10-year model. It's like a 15-minute video, and it explains what we do with the 10-year model. So basically, your money will kind of almost triple if you do nothing to it, but just start out with an investment amount and let it grow and let it ride. because we learned the time value of money. These loans are just paying off as early as 7 to 9 years most of the time. You got it, John. You got it. Good question, Patrick. Anyways, there is our note deals page, like we said. I'm getting pretty good at this. This isn't as bad as I thought it was going to be. So, you know how it is when you do something new, especially with technology. You think you're going to be floored with it. So I did practice enough. All right, we got another question here. So regarding the closing on the sample deal, would your office be responsible for creating and delivering the release deed? So yes, in the eyes of the title company, they expect the lender to do that. So who's working on my behalf? The loan servicer's working on my behalf, who happens to be Allied Servicing is the company that we use. Really good company. And so they're handling all that for me. So I don't have to do that. My servicing company does it, and they do it because I'm paying them monthly to service the loan anyways. We pay like less than $20 a month. And so it's just part of their job. That's what they do. It says, so yeah, I didn't read ahead. The servicer handles it. And that's the most common way it works. If you don't have a professional servicer, you would probably have to get an attorney involved to draft up documents, or you would have to figure out the payoff amount, and you'll probably make a mistake, to be honest with you. It's honestly brain damage if you don't use a loan servicer. So even if you're creating your own loan, you really want to have a loan servicer involved. Cool. You have your first CFD paying off. Congratulations. That's awesome. I love it. So if that doesn't answer your question, reach out to me at justin@brightpathnotes.com, or leave the comment in our Facebook group. Ask the question if that didn't answer it for you. But I think I got it. I think I got you covered. Oh, our first picture profile pops up. That's cool. I'm not going to try to pronounce your name because I'll probably butcher it up and you'll probably hate me for it. So I'll just read the question. Do you collect PITI as your underwriting requirements? You know what? I used to be a real stickler for that. For those of you who don't know PITI, he's saying principal, interest, and taxes insurance. That's our short little name for that. So I used to be a stickler for that, and I would only look at loans that had escrowed for taxes and insurance, because some loans, guess what, are not escrowed for taxes and insurance. You can ask the borrower to escrow them once you buy them, but the borrower doesn't have to do it, right? If it's not set up that way. Excuse me for a second. This broadcast is brought to you by Powerade, right? So I've gotten a little bit less stringent on that. So I would prefer to have the TI in there, but if it doesn't, it's still a good loan. I'll pull the trigger on it. So that's just my take on it. And you can kind of convince the borrower to do so. If you have a good servicer, you can tell them, be like, hey, you really need to escrow this loan. Or if they want something in return, if they're looking for a lower rate or something, or defer some payments, that's a way to get in that as well. So hopefully that answered your question. I don't know what you prefer as well, but there is no wrong answer. If it's your first time, you probably want to have an escrowed account, but you don't have to. So, good question. Good questions tonight, guys. Keep them coming. Hopefully I'm not ruining something here. Here we go. All right, I think I covered those. We had 3 or 4 come at the same time there. If I didn't pop up your question or read it, please comment back in and say, "Hey, dummy, you didn't get my question." This is different than doing it on our Zoom account, because on our Zoom account we can unmute people and have them just go ahead and start talking. On this account, it's not really set up that way for StreamYard. We have to invite you to be on the broadcast. So. All right. So this is one. It's helpful to have another person that can run the boards for you. So I am. We're about 45, 50 minutes into our presentation today. I didn't have anything else for you guys. I didn't mean for it to be super short and sweet, but maybe you like it that way. I know I allot 2 hours for this stuff. It typically doesn't. We like to talk at the end and bring up questions and stuff and try and help you in any way that we can. Like I said, reach out to me at justin@brightpathnotes.com. If you have any questions in the future, if you're looking for deals, you're looking for partials, if you need help closing a deal, we definitely can. We have services to help you out as well. On the horizon, we're going to have some technology on our side to help you guys if you want to kind of track your loans and do it in a more of a CRM type of fashion. We're going to have some stuff available for you pretty soon in a couple of months for you guys to go off of a subscription model, and we'll have some ancillary products that'll tie into that as well. We're kind of trying to make things a one-stop shop for you. So anyways, I'm Justin Bogar with Bright Path Notes. Remember, we've got the deal flow to make your cash flow. Thank you for being a part of our meetup tonight, and I hope this went well. Those of you that are live on our call right now, hope you enjoyed it. Thanks for chiming in. We have one more question that just popped in at the very last second. It says, you mentioned your podcast that you're looking to ramp up for your marketing. Can you give me some ideas on what methods work best? Well, this is a good question. I like podcasting. It's fun. It's different. So ramping up your marketing, I'm not an expert at podcasting. I know the basics of it, and I've been learning every year we've been doing this, how to get a little bit better at it. So what works best is trying to establish a following, having a good format of what you want your podcast to be. Obviously we all know 100 podcasts out there right now that are all real estate, or they're all similar in some way, shape, or form. And so you either want to stand out or you want to stick to what you feel like is the content that you want to provide to somebody. And you need to have somebody that can help you produce it, and you need to have a platform in which to output it on to all these podcasts, audio and video directories. And if you don't put it out to all the directories and all the channels, you won't get as much exposure to it. And so that's just the idea behind social media marketing as well. If you don't put stuff on all the platforms and keep people engaged and keep content going, you're just going to disappear. As they say, where does a company go to die? Well, go to the second page on Google. That's where the company goes to die, right? Oh, I'm sorry. I got off on a tangent, right? You meant, I meant ideas on note sourcing. So networking was a big way that I got into the note business, and I was able to find a lot of sellers, institutional sellers. What else I did at the beginning was I sent out a lot of direct mail campaigns. And so I would send out ones, like I live in Indianapolis area, so I sent them out to Indiana, Michigan, Ohio, I think I did Kentucky, and I would get a ton of responses from the letters that I would send out, and I would answer the phone, and I would collect information, and I would either choose to buy that loan myself, or I would call up an institutional buyer that I know, and they would figure out what price they would want to buy it for. You're playing broker or middleman with the seller, so that's one way to source deals as well. If you have your own money, it's still a good way to source deals, because those are the best deals, the most profitable deals. We're buying 3 right now from a local person. And it's getting your name out saying, hey, I buy loans, is another great way to do it. So that's kind of how I started off, and it's a slow build, and just let people know, like, hey, I buy loans. And buying mailing lists is a great way to do it. Yeah, John, so I tried to this time. If you are on our email list, you would have got notified a couple of times that we had a meetup coming up. And so from now going forward, if you are subscribed to our YouTube channel, you will get notified. I believe you get notified as we're going live. And then for the consistency of the meetup group, it's always going to be the second Wednesday at 6 p.m. Eastern is when we're going to have the meetup. So sorry about that. I'm still learning about how to do this stuff for the live broadcast and how to get the info out there. So thanks for the feedback, though. I appreciate that. And keep the feedback coming, guys. If there's something that's not coming through right, I have no idea. I hope, obviously, you're hearing me because you're asking questions and stuff. So that's a good sign. And I can see that my PowerPoint presentation is working. So yeah, this is new to me. So hopefully this was nicer than going through Zoom. If not, chime in and say, hey, man, this was dumb. Go back to Zoom, and we probably will end up doing that. So thanks a lot for all your comments and your feedback today. Like I said, reach out to Justin at Bright Path Notes, and you can watch this replay basically as soon as we're done ending the broadcast. So I'm Justin Bogart, Bright Path Notes, guys. I will catch you on the February 10th from 6 to 8 p.m. Have a good evening, guys.